$17 trillion in paper wealth vanished into thin air during the Great Depression's purge. Equities crashed 90%. 10,000 banks locked doors. 1 in 4 workers sat idle. A whole generation's savings were inflated away or lost. We call it the modern era's darkest financial reset. But the truth stackers must face in 2026 is grimmer. The storm brewing now isn't just a repeat of that history. It is far more devastating. Not just sentimentally worse, mathematically broken, fundamentally worse. Currently, total fiat debt in the American system hits $98 trillion. This includes federal corporate household and banking sector notes. In 1929, adjusted debt was just $290 billion. Essentially, the system now holds over 300 times the debt load that existed before the Great Depression began. The scale of fiat printing is just one risk. In 1929, bank runs were local events. A vault closing in one state didn't instantly wipe out wealth nationwide. Today, the beast is interconnected. Digital exchanges, derivatives, global flows, and leverage have fused the economy into one fragile house of cards. When one domino falls, the panic spreads everywhere instantly. Even more critically, the bust is not isolated. Paper stocks, bonds, real estate, and the fiat dollar itself are all buckling simultaneously. There is no rotation, no safe haven, no asset immune to the contagion. This isn't a crisis looming in the distance. It is a systemic collapse that is already in motion. Throughout history, every debt-driven collapse followed the exact same 4-stage sequence. No exceptions. In the chapters ahead, I will map out that pattern and show exactly where we sit now. This is not opinion, it is hard math. And once you grasp the mechanism, you'll see why 2026 is not a warning. It is the moment the fiat system reveals itself. Comment 1 to keep stacking or 2 to fold here and subscribe if you want to know what comes next for gold. To understand why the crash is inevitable, you must grasp the mechanism. Debt blowups aren't random. They aren't black swans. They don't rely on politics, personalities, or wishes. They follow a fixed math sequence that is repeated throughout history with mechanical precision. 4 stages, always in the same order, always with the same ending. Stage 1 is the foundation. This is the phase every stable economy begins with. Growth is driven by productivity, innovation, real output, and sound money. Debt exists, but it plays a supporting role. Credit finances farms, factories, infrastructure, and businesses that generate real returns. Income grows faster than liabilities. This is genuine wealth creation. The system truly earns its expansion. Stage 2 is expansion. Credit becomes easier. Lending standards loosen. Fiat debt begins to grow faster than the underlying economy. At first, this feels positive. Asset prices rise, stocks climb, real estate appreciates, people feel wealthier and borrow against those rising values. Banks lend more as collateral appears stronger. The feedback loop forms. Higher prices justify more debt, and more debt pushes prices higher. This phase becomes politically and economically addictive. Banks profit from loan growth. Investors profit from asset inflation. Governments collect more tax revenue from transactions and capital gains. Entire industries form around finance speculation and the leverage. At this point, stopping credit expansion becomes impossible. The entire fiat system itself now depends on debt growth to function. The danger is invisible during this phase because nothing appears broken. But the gap between what is owed and what can realistically be repaid keeps widening. Debt is no longer funding production. It is funding price inflation. The economy begins to consume its future growth to support the paper illusion of prosperity. This is the most deceptive stage of the cycle. It convinces intelligent people that the system is healthy precisely when it is becoming fragile. And once expansion reaches its limit, the transition to the next stage is not gradual. It is totally abrupt. Stage 3 is where illusion collides with reality. This is the trigger phase, and it is the most misunderstood part of every debt crisis. People assume the collapse is caused by a single event, a policy mistake, a war, or a shock. That belief is wrong. The trigger is never the cause. It is simply the moment the system can no longer roll over its paper debt. At this stage, something small breaks the cycle of expansion. It can be a change in interest rates, a regulatory shift, a loss of confidence, or a foreign disturbance. The spark itself is irrelevant. What matters is timing. The weakest borrowers suddenly cannot refinance old debt with new debt. Defaults begin quietly, often in corners no one is watching closely. Because the system is heavily leveraged, those small failures do not remain isolated. Asset prices stop rising. Then they flatten, then they fall. As prices fall, collateral values decline. When collateral shrinks, lenders pull back. Loans are not renewed. Credit lines are reduced. Borrowers are forced to sell assets to raise cash quickly. This is where the feedback loop reverses. Forced selling pushes prices lower. Lower prices trigger margin calls. Margin calls force more selling. Liquidity evaporates. The same mechanism that amplified gains during expansion now amplifies losses during contraction. Greed is replaced by fear. Lending is replaced by hoarding. Trust disappears completely. Here is the critical insight most people miss. The debt does not vanish. Every dollar of debt is someone else's asset. When borrowers default, lenders absorb the loss. When lenders take losses, they cut credit. When credit contracts, the economy shrinks. Shrinking income leads to more defaults. The loop feeds itself constantly. Once this phase begins, policy tools lose their power. Central banks can inject liquidity, but they cannot force lending. Governments can stimulate, but they cannot restore solvency. The system is no longer expanding, it is deleveraging. And deleveraging always accelerates rapidly. This stage feels chaotic, but it is not random. It is the inevitable result of too much debt built on inflated prices. And once the trigger phase is fully engaged, there is only one stage left now. Stage 4 is the part history remembers, but only after it has already passed. This is the destruction phase, when the system resets itself by force. Debts that cannot be repaid are eliminated either through default inflation or a combination of both. Asset prices collapse until they reflect real economic output rather than leveraged expectations. Wealth does not disappear evenly, it concentrates quickly. Those holding paper claims tied to inflated values are wiped out. Stocks priced for perpetual growth bonds, priced for stability that never existed, and real estate bought with excessive leverage all reprice violently. The middle class whose savings are concentrated in these assets absorbs the majority of the damage. This is not punishment. It is sheer mechanics. Cash flow dries up. Businesses fail. Unemployment surges. Governments face collapsing tax revenues just as social support demands explode. Social tension rises because economic pain always manifests politically. Trust in institutions erodes. People search for someone to blame, but the process itself is indifferent to narratives completely. At the same time, a transfer occurs. Those who held liquidity, real assets, or claims outside the inflated system gain relative power. They acquire assets at fractions of previous prices. This is how wealth consolidates after every major debt reset, not through conspiracy, but through proper positioning. Eventually, after enough destruction, the system stabilizes. Debt levels fall. Prices normalize. Productivity slowly rebuilds. A new foundation forms, and the cycle begins again because human behavior does not change. Confidence returns. Memory fades. Leverage reappears again. Every major collapse in history has followed this exact four-stage structure. Foundation, expansion, trigger, destruction. Different centuries, different currencies, different technologies, identical outcomes. The names change. The math does not lie. Understanding this sequence is not about fear, it is about clarity. If you can identify the stage, you can understand what actions make sense and which ones are suicidal. And to see how precise this pattern really is, we now need to look backward at history and compare it point by point now. The Great Depression is not a mystery. It is one of the most documented financial collapses in history, and it followed the four-stage pattern with exact precision. Stage 1 was the post-World War I foundation. The United States emerged as an industrial powerhouse. Productivity surged, manufacturing expanded, real economic growth supported rising incomes. That foundation was fully legitimate. Stage 2 arrived in the late 1920s. Credit exploded. Margin debt allowed investors to buy stocks with as little as 10% down. Asset prices disconnected from reality. From 1925 to 1929, stock prices tripled while earnings lagged behind. Price-to-earnings ratios climbed above historical norms. Speculation replaced investment. Florida real estate boomed. Get-rich-quick schemes flourished. Debt accumulated quietly beneath the surface now. Stage 3 was triggered in October 1929. As stock prices slipped, brokers issued margin calls. Investors had no cash. They owned stocks purchased with borrowed money. To raise cash, they sold assets. Selling pushed prices lower, triggering more margin calls and more forced selling. Within days, panic spread. Liquidity vanished. The feedback loop turned fully vicious. Stage 4 dragged on for years. From the top to the bottom, the paper market crashed nearly 90%. Over 9,000 banks folded. Savers lost their deposits. No FDIC, no bailouts existed. GDP cratered. Official jobless rates hit 25%. Real numbers were much worse. Society started ripping at the seams. Soup lines grew. Families lost the farm and home. Real wealth consolidated as those with capital scooped up hard assets for pennies on the dollar. Every phase of the four-stage cycle played out exactly as the history books predicted. None of it was accidental. Crucially, the masses believed it couldn't happen again right until it actually smashed them. This is why studying history is vital. Not because events clone themselves, but because human nature does. Once you spot the setup, you see the same Ponzi scheme repeating across different nations, failing fiat currencies and centuries of time. If the Great Depression feels too old, there are faster, more brutal examples that destroy any doubt. A prime case is Germany's implosion in the early 1920s. Before the crash, Germany had a solid industrial engine, high-tech factories, and a skilled workforce. That was the foundation phase. The real economy itself was not the weak link in the chain. Stage 2 kicked off after World War I. Debt reparations demanded far more than taxes could ever cover. Instead of a hard default, the state chose the printing press. Currency creation started slow, then went vertical. Initially, the ROT looked manageable. Wages climbed, jobs stayed. The public thought stability was back. That money illusion is always most potent during the initial pump. Stage 3 hit when the confidence game broke. As the printers ran hot, the mark softened. Foreign debts and internal chaos pushed the system over the edge. The exchange rate tanked. Prices didn't just rise, they went hyper. What was simple inflation morphed into a total loss of faith in the fiat paper itself. Stage 4 was absolute destruction. Paper savings denominated in the currency became worthless. Pensions evaporated. Middle-class wealth vanished almost overnight. Those stacking real assets, foreign cash, or hard money survived. Everyone else was wiped out. The reset was swift and total. A new currency appeared, and the old paper became trash. The lesson from Germany is velocity. When faith in fiat breaks, the shift from stability to ruin takes months, not years. The same four stages played out, just compressed in time. Debt that couldn't be paid was liquidated through hyperinflation rather than an honest default. This case matters because it reveals another route through stage 4. A crash doesn't always come via falling asset prices. It can come via currency destruction. And once that death spiral starts central, planners lose control of the system even faster. History doesn't whisper warnings. It screams them. To grasp the full scope of the coming storm, we need one more modern example that played out in agonizing slow motion. Japan offers the modern blueprint for what occurs when a debt bubble is propped up too long. After World War II, Japan laid a massive foundation. Manufacturing, exports, and hard work drove real growth for decades. That was stage 1. The economy actually earned its massive boom. Stage 2 took hold in the 1980s. Credit creation accelerated. Banks lent aggressively against rising real estate values. Asset prices went parabolic. Land in central Tokyo was valued higher than entire countries. The market tripled in a few years. Price-to-earnings ratios reached extremes. Debt expanded far faster than income. The financial arrogance was absolute. Stage 3 sparked in late 1989 when the central bank hiked rates to cool speculation. That single pivot broke the refinancing cycle. Stock prices peaked and crashed. Real estate followed suit. Collateral values fell. Banks faced losses on loans backed by bubble assets. Credit froze up completely. Forced selling kicked in. Stage 4 unfolded over decades rather than years. Asset prices crashed more than 70%. Zombie banks failed or survived only on state lifelines. Growth stagnated. Wages flatlined. The economy entered a long paralysis known as the lost decades. Intervention delayed the collapse but didn't cure the debt overhang. The structural economic damage became permanent. Japan proves that even advanced nations with strong institutions can't escape the fiat debt cycle. It also exposes the cost of meddling. When the crash is kicked down the road, the recovery is neutered. The system survives, but prosperity dies. These three examples, America, Germany, Japan, span different cultures, fiats, and eras, yet each followed the same 4 stages. The differences are just cosmetic. The mechanism is universal. Now, with that context, we can map the pattern directly onto the United States situation right now. Now let's map this to the United States in 2026. Stage 1 is done. America's foundation was solid. After World War II, we emerged with industrial might factories, trade surpluses, and a dollar backed by gold under Bretton Woods. Productivity drove the wealth. Debt existed, but it was restrained and supported by real output. That historical phase is undeniable. Stage 2 started in 1971 when Nixon closed the gold window. With that default, all restraints on printing vanished. Credit market debt was near $2 trillion then. Today, it's $98 trillion. That isn't inflation. That is exponential leverage. Federal debt exploded. Consumer debt multiplied. Corporate borrowing surged. The financial sector became the biggest debtor in the entire system. Every crash since was handled the same way: lower rates, more juice, more debt. The 2001 recession fed the housing bubble. The 2008 GFC produced ZERP and QE infinity. The 2020 shutdown printed trillions in months. Each bailout pumped asset bubbles larger and pushed the system deeper into fatal dependency on credit expansion. The result is an economy not driven by production, but by asset inflation. Pensions need constant casino gains. Retirees depend on rising paper prices. Banks hold trillions in toxic long-duration bonds. The state relies on capital gains taxes. The financial sector now dominates profits. If asset prices drop meaningfully, the whole leveraged house of cards collapses. That is the trap. Rates can't stay low forever, but they can't rise without nuking the system. Stage 2 is finished. Fully, historically extreme by every single metric. And once the credit expansion reaches this point, the shift to Stage 3 is certainly not theoretical. It is already happening now. Stage 3 is no longer coming. It is here. Multiple crisis triggers are battering the system at once, and that makes this cycle uniquely dangerous. In past crashes, stress appeared in one sector first. In 2026, the pressure is hitting the system everywhere simultaneously. Interest rates are the first trigger, after years of ZERP rates hiked at the fastest pace in decades. This shattered the debt math across the economy. Federal interest costs surged. Zombies face refinancing at double their old rates. Commercial real estate can't roll over loans at these valuations. Regional banks sit on massive unrealized losses. The economic model built on free money is dead. Liquidity is the second trigger. Emergency buffers that once absorbed shock are nearly tapped out. As safe havens to park capital vanish, markets get shaky. When liquidity dries up, price discovery turns violent. Small market moves cascade into forced liquidation. The third trigger is global. Japan is tightening policy to save the yen, forcing the unwind of massive carry trades. Trillions borrowed at near zero are coming home. That repayment forces the sale of foreign assets, including U.S. stocks and bonds. At the same time, foreign demand for U.S. treasuries is falling. Major holders are now aggressive net sellers. The fourth trigger is commercial real estate. Trillions in loans are maturing against assets worth far less than when the paper was signed. Defaults are starting. Stress is infecting the banking system. These aren't isolated failures. They are global, synchronized shocks. This is how Stage 3 looks in real time. Asset prices soften. Collateral weakens. Credit tightens. Margin calls go out. Forced selling ramps up. Liquidity evaporates. The doom loops are fully engaged. The system is no longer stable. The only remaining question isn't if Stage 4 arrives, but just how fast it accelerates. Stage 4 is starting, and it won't resemble past crashes in scale or speed. The Great Depression wiped out roughly $17 trillion in today's terms over 4 years. The system entering 2026 carries nearly $100 trillion in debt, layered with leveraged global ties and fragile faith. When deleveraging finally speeds up, losses compound fast. This time, no asset class is safe. Stocks tank as earnings die. Bonds crash as deficits force more printing. Real estate reprices as refinancing fails. Unlike 1929, the currency itself is weak. Governments can't absorb losses without debasing the dollar. Central banks can't intervene without sparking inflation. Every policy choice transfers pain rather than removing it. This is why faith in a Fed rescue is misplaced. You can't print solvency. You can't force trust. Debt that can't be paid will be defaulted on or